All right, welcome back to Rain King Insights. Welcome to all the people in the membership, and welcome to those of you who are joining us for this free monthly public video. There is a lot to cover this week, and there's some good educational lessons along the way. So I'm recording this at approximately 3:40 Eastern Time. Markets, after their gap down this morning on tariff news, etc., the markets are just coming off their lows. Before we dig in, let's just remember that Rain King LLC is not a registered investment advisor, and all these videos are for educational purposes only. Okay, we've got 4 topics today, as you see on the screen. I think we'll start with on June 27th, the last public video that we had. I basically explained a really bullish case, and I said I think we could have some fireworks in July, and the market was really going to have a surge. And we've gotten a great July. It's been a good month. Things really escalated into some really good trades. Now, what was interesting was here we are less than a month later. I had a GMU that I put out last Thursday night, July 24th, which was a pretty critical general market update. And it was all about the breadcrumbs, about looking under the surface at the market, looking at the health, and we were getting much more defensive in the membership. So let's dig in here and talk about what we saw. So flexibility. It's important to always be flexible. You might be a raging bull one week, but if the market turns and changes, you have to be unbiased, read what it's telling you, and be able to change your mind. So this was from the slide from last June 27th. This was all about S&P positioning. And this was one of the slides I used that made the case that we could actually see institutional FOMO and July fireworks, which actually did come through for us. So we were prepared for that and took advantage of that with some pretty good trades. Now, there's been really a thinning of the herd. This is what I started to describe in last week's video. So if you haven't watched it, you definitely need to watch it, though you're 1 week behind the real message of the video, and you might have gotten hurt this morning. So in the video, and I'm not going to share all the detailed graphics that were in that video, but the bottom line was we talked about retail excess speculation. We talked about a chart that showed that zero-day option trading was at historic highs, showing a lot of retail speculation. And we also had a statistic in a graphic that showed 26% of all trading volume of the last few weeks ago was stocks under $5 a share. Now, that is not institutional buying. That is the public, that is the herd, that is the crowd, that is retail traders buying and speculating on penny stocks. So all of these were part of the puzzle that we were looking at, the breadcrumbs. We also looked at a couple of graphics that showed that the equity put call ratio was really at low ratios, and it was showing a lot of complacency, and we flagged that as a potential concern. We also looked at the VIX. The VIX was really at a low reading. Again, more complacency in the market, even though the breadth of the market was thinning out. And we're going to look at that a little closer. So that all got the whole membership. The message of the July 24th video was all about getting more defensive. And we, at the Rain King level, we talked about really reducing any on-strength buying, making those absolutely a minimum. And we also started to focus more on pullback setups, anticipating the market might come in. We also raised our stops, and those stops were wise to raise those at that time as the market was showing caution signs. And we got taken out of Coupang and Soundhound for gains or breaking even versus taking losses. We also took our gains offensively on the way up. We had a great sell in the hood trade, which is over 110%. SMCI, GEV, and AMD were all timely trades that made good returns. Now, this week, we got some really good tariff news, if you say, about the European Union. You say, boy, that's a really interesting, good deal. Shouldn't the market really be rallying? And it was a clue when the market really had very little upside reaction. If the market can't rally on good news, that's a cautionary sign in itself. We also had what I call 4 bad up days, and I'll go over this in a moment on a chart. 4 bad up days that we've had over the past 2 weeks. Essentially, that's when the index is moving higher, but under the surface, the breadth is really weakening. And we've also noticed that leadership in the market was really becoming concentrating. The semiconductors were really leading the way, and the Mag 7's earnings headlines were also leading the way. Meta, Microsoft, Google with all of their AI spend, which was all positive for the market in terms of the AI build out. But even on Thursday and Friday, Meta and Microsoft have given back their gap up gains to some degree. So a couple things to follow up on that cautionary sign of why we were being cautious. This is actually a chart of the S&P 500, and very simple. This is upper panel is the S&P stocks above their 50-day moving average, and this is the daily candles. So you can see here, I've just drawn a vertical line. We had a new high in the S&P, and you can see we basically had new highs in the stocks above their 50-day. But the latest new highs that earlier this week, you can see the deterioration. We don't have a new high in the stocks above their 50-day. That's a small divergence. That in itself is not enough to really change our opinion totally, but we want to put it in the back of our mind. It's a small divergence. Now, if we keep looking under the hood, now I'm taking the S&P 500, and on the upper panel, I've put the S&P equal weight, RSP, on a line chart. And you can see there's a dramatic difference here. You can see that the last new high we had in the equal weight was November of 2024. And that's when the S&P was also making a new high. Well, the S&P made a new high on February 19th. We did not make a new high in RSP. We had the tariff meltdown, but you'll notice that the recovery, the S&P has gotten back to new highs and has been grinding higher, but we are well off any new highs in the equal weight. Really, it's a divergence that's continuing. It's continuing now for months. So, you know, the main S&P has a lot of tech stocks in it and Mag 7s now. So that's really what brought this up, but it's another divergence. Now, if we zoom in on just the S&P 500 here and looking at really the last couple of weeks, and I really want to focus on these last basically 10 days and graying out before that, because this is the analysis we talked about last week in our update. We talked about a bad up day. Now, a bad up day, as I mentioned, is when the index is up for the day or only tiny little bit down, but yet the breadth of the market is poor. So on this chart, these tags are showing us the breadth of the market. So on this particular day, I think it was July 18th, we had decliners, actually 1.5 to 1 over the advancers. But the market basically closed about neutral. That's a bad up day. The very next day, we tried to go to new highs, and we had another bad up day, 1.1 decliners to every advancer. So that was another caution sign. Then we had a couple of decent days in here where we had advancers and the breadth was okay, but this was a very bad clue here. This is a really bad day. This is a day where decliners led 1.9 to 1, and we had heavy volume on the index without any progress to the upside. And then you can see we came back a couple days later with another 1.9 bad up day, and there was also new highs on lower volume. And then we had a neutral day. And then yesterday and the previous day, we had some, again, more decliners leading the breadth of the market. This 2-week period was giving us a lot of clues that everything was not okay and that we needed to get much more defensive. Today, obviously, is the gap down. And if you weren't prepared, you may have taken a hit. So let's go a little further into the indices, this thinning of the herd. Now I'm going to switch to the NASDAQ. There's a lot of good lessons in this chart. So we'll take our time, we'll go through it. Let's look at the basic things here. Again, in particular, we're looking at the last 2 to 3 weeks. So what I have plotted on the chart, the upper panel is the NASDAQ stocks above their 50-day moving average. Then we have the daily NASDAQ. And then in the lower panel, we have net new highs. So I've just kind of drawn these vertical lines at key points when the NASDAQ was making new highs. So at point A, everything seems to be in line because we have new highs in the stocks above their 50-day, We have a new high in price. We have a net new high. This is the highest net new high reading we had in a long, long time. So everything looks good here. And the net new highs was 279. So at point A, the market looks good. Then we get to point B. This is where the NASDAQ had a stalling day. And you can see we made a new high intraday, but the net new high was only 169. You can see it reflected here. It's much, much lower. And we're seeing deterioration in the stocks above their 50-day moving average. So that's the first divergence. Then we have point C, and point C was on Wednesday. You can see again that the index tried to make an intraday high. You'll notice that we have further deterioration in the number of stocks above their 50-day, and the net new highs is weakening again. Now we're down to only 116 stocks. So you see declining new highs, weakening in stocks above their 50-day, yet the index is continuing to look okay. And if you're only looking at the index, you might think the market is fine. So we've got some conflicts here. We've got some divergences. This is all the tea leaves we're reading. Those breadcrumbs are important to make sure we have the proper exposure and we don't get hurt in the market. Now we're in a bull market, and we've come a long, long way off of the lows that we had in April. So pullbacks are normal. So this pullback that we're having, hopefully is going to be a normal pullback. Maybe it's going to be 3 to 6%. That would be completely normal in a bull market. You're going to have some backing and filling. You'll also notice that in the split of the net of the stocks making new highs and new lows are actually picking up as we were up near new highs. Again, another key divergence to look at. And obviously today, when I put today's candle on it, we can see there's the 2.3% gap down as of the recording of this video. We had just come off the lows a little bit. But all of these pieces were telling us that this shouldn't be surprising. And I do think we're going to come back in maybe 3 to 6%. All right, now I want to go one step deeper because I think there's another really great teaching lesson here about chart reading. Many of you might be can slimmers, and you're going to say to yourself, hey, John, where's all the distribution days that Can Slim teaches us for a market top? You know, we're looking for a 0.2% decline on higher volume to tell us there's a distribution day. And I've marked the distribution days on this chart. And you'll notice over the last couple of weeks, we have not had really an outright distribution day. So I'm going to break this down with some kind of, I guess I call it some advanced chart reading, some of the little clues that could tell you that you got to use all your tools when you're reading tops and bottoms in markets. So it's subtle, but stalling days are what this was really telling us what was going on with the market. So let's break it down. And I've got it broken down into these 5 points. So point 1 here in pink, this is the first stalling day that we had with the market moving to new highs. This is really no concern. You're going to have days that the market comes up and it kind of reverses. That's normal as an uptrend. So that really is nothing to get concerned about yet, but you note it, it's stalling. Then we have at point 2, now we're talking, the market is again trying to get to new highs, and we come all the way back down, and believe it or not, it's a blue candle. It furnishes blue. So people say, you know, some people might not recognize this as stalling, but the volume did pick up. It did pick up because basically as the market moved up, there were sellers that pushed it back down with more volume. That's really a bad up day when you combine it with the advanced declines that I just showed you on the previous chart. Now, point 3 is probably the most important one to me in all my years of looking at market tops and bottoms. And it's what Bill O'Neill taught us. He said HVWO FPPU. And what that stands for is heavy volume without further price progress up. This is more serious after you've had multiple stalling days, because what this is telling us is that the market really picked up in volume, and yet it couldn't go anywhere. You can see it just basically finished right about where it was. It's really stalling. It's telling you there's churning, almost balance between buyers and sellers. Another clue, when we start to see this now in a couple of days, that's telling us the market is becoming very tired. At point 4, the market again opens up, it gaps up, and we actually close and reverse down. Now, an amateur chart reader would say, well, what's the big deal? The volume is lower than before. But in the context of what's going on over here, you have another new high attempt reversing on lower volume, which doesn't look like it's a big deal. But what it's telling you is that there are no buyers up here. No one is willing to step up and buy. And if there are no buyers, then the price needs to come down in order to attract buyers. So you get a situation where the volume doesn't look bad, but yet it is a very bad day when you look at it over the past 2 weeks. Then we have Thursday, which was the big reversal day. This is probably more obvious. We gap up and a big reversal down, a big red candle, and the volume did pick up. So that's where it becomes much more obvious to people to say, oh, this is not so good. Even though the close did not qualify as officially a 0.2% decline on higher volume, it wasn't a distribution day. But you can see 3 stalling days and this other day here. When you put it all together with the advanced decline numbers, those are the readings that I was doing to say this is really not looking right. And we need to be very, very cautious, particularly about any new buys. So I do think the market could come in. This is purple day is the 20-day. That would be about a 2% pullback. And then a 5% pullback would take us down to the red line, which is roughly the breakout level and the 20,000 level in the NASDAQ. Again, this pullback here could be very, very normal in an ongoing bull market. So the thinning of the herd, I'm still very, very bullish on this bull market. I think there's going to be huge potential opportunity in Q4 and in 2026, a huge opportunity. Q3 here is we're just getting started. Maybe we get a little pullback. We've come a long way from where we were back down at those panic lows around the tariffs. So some backing and filling for the next 4 to 6 weeks would not be a disaster at all. Signs of weakness, as I pointed out in the charts, you can't ignore them, but they really don't matter until they do. And today they obviously broke wide open. So if you weren't paying attention at all, you probably were surprised. Now, I will emphasize, I don't think it's a sell everything situation at all. I do think it's a trimming situation depending on how you're positioned. And so we'll talk a little bit about how we jockey for positioning on a pullback. So let's get into this. I've used this chart before. This is from July 9th. This is the follow-through day, and I've mapped out all the breakouts. We've talked about this multiple times. You want to be aware of who the leaders are, particularly the ones in blue, which are IPOs in the last 4 years. They can be really, really big runners. So we always want to be aware of who really is exhibiting the strength. This is from July 11th. So I use this kind of analogy of, bull market runs are kind of like a jockey on a horse. And I would say that this bull market really got started in earnest in November of 2023. And, the analogy is coming out of the starting gate, you get a lot of horses, and we never know for sure which horse is going to be the huge winner coming out of the gate. Bull leg number 1 took us to the summer of 2024, and then we had a correction. We had a correction in August and September of 2024. Those are the horses coming down the back stretch. Now we came out of that correction and we moved higher, and we moved higher until about February. And March and April that's when the market got into trouble for another pullback correction. It was actually technically a mini bear market with the tariffs in April. And now we've come out of that. So in bull leg number 2, you're really trying to understand, are you on the right horse? If you were on a slow horse in the backstretch, you might want to saddle up and say, I got to find a better horse. Now, if you have nailed one of these winners from the starting gate, then you want to ride that horse harder. You want to build a bigger position. You probably got a lot of cushion in it, and you want to try and maximize your returns. So probably going to go through a little bit of a correction here in August, maybe September. but then we'll probably move higher. And then we'll get into the, as the bull market continues, you're going to be coming around the final turn at some point, and eventually the market will top at some point. And that's when we really have to sell our big winners right if we're going to capture and really capture those big gains. So this idea of jockeying for position is important. As I mentioned, here's two scenarios. The first scenario is you nailed it. You got in April and May, you made the right buys on what you thought was going to be the leader. You said, oh, I'm going to buy this stock. I think it's going to be the leader. Now it moved up, but it didn't move up as fast as other stocks. You were on a slower horse. So you say, okay, if we're going to go through a little bit of a correction here in August and September, I probably need to resaddle up and find out who is the new horse that I want to get on after this pullback is over. Because just because you missed the alpha dog leader doesn't mean you can't find a way into it when we get a pullback. So you could be in that situation, or you could be in scenario B. And let's say you did nail one of the big leading stocks and you have a huge cushion in those stocks. It's done really, really well for you. Now you're in a totally different mindset. Your mindset should be, when we correct in August and September, potentially, I want to find ways to add to my position. Your mindset is, how do I add to really ride this horse all the way to the finish line? So either way is a way to, get on the right horse. Either you've already identified it and you nailed it, or you maybe got on a slow horse and you need to change it. So it's all about positioning. Now you need to rank your stocks. You should be doing this at least over the weekends and say, what is your best stock? And sometimes your best stock is not the stock you have the most gains. Sometimes it is, sometimes it isn't. You want to think about the risk and reward. How extended is your stock? Do you have the right horse? Look at the chart, look at the company fundamentals right now and say, if I had to do it all over again, would I buy this stock right now? What is the upside potential from where I am right now? And what's the downside risk? Ask yourself those questions when you're looking at your portfolio of stocks. Also ask yourself, what is the catalyst that's going to drive this stock higher? Is it a new product, new sales, new management? Maybe it's something in the AI theme that's coming that might drive it higher. And do you have the conviction? You really know this company that you say, I can hold this through a pullback because I really believe it's going to be much higher 1 to 2 years from now. Don't hope. Really know your stock and know what its potential is. Now, when you get a pullback, the nice part of a pullback is you can create a shopping list of the leaders, because it's very important. Even though today was a very, bad day, you want to identify which stocks actually showed resilience today. It's a big clue because it's telling you the stocks that don't come down very much or get support on key moving averages. It's telling you that those institutions are using the weakness to buy more shares and they're supporting the stock. I took a look through my watch list and some of the names today, and these names really seem to be holding up well and came off their lows. The semiconductors are strong. These are 3 of the strongest. Though right now, I think AMD seems to have the most potential. CLS, Oracle, these are all some of the infrastructure stocks, connectors for data centers and AI. They have acted pretty well today under a bad tape. STX, GEV, Hood, Palantir, Net, all big tech stocks, infrastructure stocks, even some crypto exposure and Hood have all done decently today. Dash, you'll also see some of the defense names have hung in there pretty well. GE, HWM, KRMN, and some of the crypto, ETHA and IBIT, seem to be holding up decently in a very bad day today. So you want to make this shopping list, and you really want to know when those stocks set up. And by that, I mean you have a strategy for how you're going to buy pullbacks. When they set up, you want to be ready. Again, I'll mention it again. It's not a sell everything situation. I do believe the market is going to go much higher in Q4 and 2026. So you want to either add to the leaders that you have cushion, or if you miss these stocks, you can find a way on a pullback to probably enter one of these positions and get involved with one of the leaders. It's important to focus on the leaders, not the laggards. So as I always say, defense first, but there's no time to panic here. Again, not a sell everything situation just because there's been a bad couple of days. We do want to look at our sell rules. If your stocks are exhibiting offensive sell rules, you might want to bank some gains. If you see defensive sell rules that are triggering, don't ignore them because you don't want to lose the gains that you may have. You know, when you are doing really well in the market, you really want to monitor yourself. If you're having a nice win streak and you've had 4, 5, 6 trades in a row well, and you've had a really, really strong July, watch being overconfident and excessive risk-taking. You know, retail traders are very susceptible to starting to take high-risk trades after they had a little nice win streak. You got to monitor yourself and make sure that you're still staying balanced. You know, in the membership, we were selling Hood, you know, last week when everybody kind of was looking at it saying, why? It's such a strong stock. Well, it triggered an offensive sell rule and we captured the gains. So look at the heat in your portfolio. Sometimes you need to reduce some exposure, maybe raise some cash to be ready to make some pullback buys. All right, let's try to summarize a long video, but I think it's a useful one. The Mag 7 is really going to be the last to correct. They've had some great earnings reports. Some of them gapped up. Some didn't do so well, like Amazon today, but they're going to be the last ones to correct. And I believe this correction has been a really narrowing rally. It started about 10 days ago, and we were all over it. You got to really decide which names are you going to want to hold through a pullback. Really think it through and decide if you have enough cushion to do that. As I mentioned, watch the leaders. The leading stocks are going to give you big clues if institutions are really supporting them or not around key moving averages. Use your sell rules, offense and defense. Don't make trades how you feel. Don't be relying on the news and talking heads. Use your rules. That's so important. So you want to have a plan, but you also want to be flexible. So the markets are just coming off their highs, but as I mentioned, the market is pretty tired here and it kind of deserves a rest coming off the pretty relentless advance off the April lows. The power trend is still in place, so we're still in a strong uptrend. Now, the NASDAQ new highs are continuing, but they're not confirming the index. That was one of our concerns, and the new lows are picking up. So we're going to watch this closely to see if the market stabilizes on the pullback or we see further deterioration and we might need to be even more defensive. The leading stocks, I think really it's been a narrowing for the past 2 weeks. Semis have really dominated. Mag 7 have dominated. The true leaders, as I mentioned, are going to stand out on the pullback. They should be obvious to you that they're not selling off. Exposure levels this week reduced about 10%. We reduced a little bit last week. Somewhere in the 65 to 70% range seems to be about right. As I mentioned, we've had some bad up days the past week. There's been some deterioration. We're going to pull in, but hopefully it's just a normal pullback within an ongoing uptrend. Slow down new buying. Got to be strategic here. And that's when you're thinking about how do you add to your winners and force feed them and cut any losses very short. The pullback could be 3, 5, 6%. But again, I think there's going to be a huge opportunity in Q4. Okay, a quote of the week is from Brent Donnelly, who wrote the book Alpha Trader. Trading is a complex, chaotic, loosely structured game played by the smartest minds and the most expensive computers in the world. It is the ultimate puzzle. The game is constantly changing, and the rules, mechanics, and probabilities are difficult to observe and forever in flux. And just when you think you got a plan, bam, you get punched in the mouth. Mike Tyson said it. Brett Donnelly said it. You got to have a plan. Days like today are going to happen, but you've got to be attentive on a daily basis to the market. Follow your routines. Watch with the market and observe the action of the market and try to stay balanced. In days like today, hopefully you're in a better position because you've been positioning yourself well before the crowd. That is the general market update for August 1st, 2025. For those of you that are not members of the site, check out RainKingInsights.com. We'll teach you all about how to read the market, how to place trades, and how to be more successful as a growth investor. Have a great weekend, everyone.